Hello, everyone. My name is Dan Ellerbrock, and I'm a shareholder with the law firm of Gregerson, Rosow, Johnson, and Nilan in Minneapolis, Minnesota. I'm talking today about one of my favorite topics, the financial institution bonds loan loss exclusion. While I could talk for many hours about all the different circumstances in which it has been applied, I'm going to focus today mostly on the history and development of the exclusion, and also the rationale of why it exists and the role it is meant to play under the bond. So the first thing to know is that the loan loss exclusion has been part of the bond from the very early stages. The first banker's blanket bond was released in 1916, and by the early 1920s, we see evidence of the loan loss exclusion being included. We see here, for example, a 1922 version of the standard form number 1 bond, which states this bond does not cover any loss the result of any loan made by the insured or by any of its employees, unless the loan was made with the intent on the part of the employee to defraud the insured. We also see similar language used in the 1930s and the standard form number 8 version of the bond, revised in 1936. So we see right from the start that the loan loss exclusion has been a central and defining part of what the bond does and does not cover. And the bond has been clear that losses from loan defaults or other losses from the bank's normal lending operations are going to be excluded. Over the years, the bond's loan loss exclusion has continued to develop and be revised to make that distinction and separation between covered and uncovered risks more clear. So we see that by the time of the 1950s, the bond has been revised to make clear that the exclusion applies to either a complete or partial non-payment of the loan. The bond has also been revised to add language at the end of the exclusion, stating that the exclusion applies whether it was a loan procured in good faith that just happened to fail, or a loan that was obtained through fraud or false pretenses. Skipping ahead to 1969, the exclusion is revised and updated again to state that it applies to non-payment of a loan or any transaction in the nature of or amounting to a loan. So regardless of how the bank and its borrower may have structured the transaction, if it is in the nature of lending money to the borrower, the exclusion applies. The 1969 revision also adds that the exclusion applies to loans or other debts that the bank has purchased or acquired from others, like a participation interest in a loan, or a package of loans or mortgages it might buy from an originator. The exclusion treats those as part of the bank's overall lending operations and excludes losses from those types of activities too. Then, as we move into the 1980 and 1986 revisions, we see that the bond continues to refine and clarify what it means by a loan. We have the 1980 version making clear that it applies to a loan or any extension of credit. And in 1986, the bond is revised again to make the word loan a defined term, which is broadly defined to mean all extensions of credit by the insured and all the transactions creating a creditor relationship in favor of the insured. The other significant change we see starting in the 1980 and 1986 versions of the bond is that the exclusion now provides that it applies to a loss resulting directly or indirectly from the non-payment of or default upon a loan. The exclusion as it exists today is largely the same as the standard Form 24 version from the 1980s. Provides that the bond does not cover loss resulting directly or indirectly from the complete or partial non-payment of a loan, broadly defined, regardless of whether the loan was procured in good faith or by fraud, except when the loss is covered under one of the insuring agreements listed, such as Insuring Agreement A for employee dishonesty, or Insuring Agreement E for certain securities and other documents that are forged or altered. So you see that what has evolved is a broadly written exclusion, subject to what the 8th Circuit and Ohio Savings Bank called limited exceptions. Similarly, the court in the Humboldt Bank case says that the loan loss exclusion sweeps away all loan losses caused by fraud, no matter how pervasive the fraud, unless the loss falls within one of the narrow exceptions to the loan exclusion. So that is the history of how the exclusion is developed. But what is the exclusion trying to accomplish? Well, fundamentally, it is trying to divide and allocate risks. As with any kind of insurance, the bond is a contractual arrangement that defines how risks should be shared and allocated between the insurer and insured. As we see in the treatise cited here, for nearly a century, the loan loss exclusion has been the primary arbiter of risk allocation between financial institutions and their insurers when credit or lending activities are involved in a claimed loss. And what the loan loss exclusion says is that, subject to certain exceptions, the bond generally does not cover any losses resulting from loans. The bond only covers specific risks that are listed in the bond. The normal risks of lending are risks that remain with the insured. In other words, the loan loss exclusion makes clear that the bond does not provide credit insurance. The bond is not guaranteeing the bank against the risk of a borrower failing to repay the bank or a loan going into default. As we see in the quote from Republic National Bank, the bond does not protect the bank when it simply makes a bad business deal. And as we see in the Fifth Circuit case cited beneath it, the bond also does not provide insurance against losses from bad debts or from uncollectible accounts. Those are credit risks that are allocated to the bank. So why does the bond do this? What's the rationale? What's the reason behind the exclusion of credit risks? Well, one answer comes down to the simple feasibility and cost of providing credit insurance. If the insurer were to provide coverage against the risk of default of every single loan a bank makes, the insurer would have to essentially take up residence in the bank's lending department in order to adequately understand and evaluate and underwrite that risk. And the insurer would have to be constantly reevaluating how many loans and what kind of loans the bank was writing. So as a practical matter, it would be basically impossible to write such insurance in an actuarially sound manner. Moreover, even if an insurer was willing to offer such coverage, the insurer would have to set such a high premium to cover the risk of default for any possible reason that no bank would want to pay the premium for that coverage. The loan loss exclusion instead tries to create a compromise between coverage and cost, and it creates a lower premium by agreeing to cover a more limited set of risks. Second, the loan loss exclusion also allocates risk based on who has the expertise and who is in the best position to be able to avoid the loss. Essentially, the loan loss exclusion recognizes that banks are in the business of lending and that credit risks are within the expertise of the financial institution. As the Flagstar Bank case recognizes, banks have the means and experience to know how to assess the creditworthiness of their borrowers. Banks know how to assess a borrower's cash flow and their ability to repay a loan. They also know how to appraise and value the collateral put up for a loan, and how to make sure that collateral is adequately protected. In fact, they're required to do all these things by federal regulators as part of running a safe and sound bank. Importantly, the bank, as opposed to the insurer, is also the party that is directly involved with the individual loan transaction, has access to information, and is able to evaluate and investigate those risks through its normal credit and lending due diligence. As the court in Liberty National Bank recognizes, the allocation of credit risks to the bank arises from the practicality of the situation and the fact that the bank has access to credit checks, appraisals, title searches, and the like. The bank is also in touch with the relevant parties to the lending transaction and can do its due diligence by contacting the borrower and any other involved parties. The insurer cannot. So the loan loss exclusion reflects these facts and provides that if the bank can reasonably protect itself from the risk, it should be the one responsible for doing so. The bond will still protect the bank from other risks, like forgeries and counterfeit that are harder to detect, but the bond is not going to insure the bank from losses it could have easily avoided if it had just followed sound business practices. Or as the Sixth Circuit said in the Bank of Ann Arbor case, the loan loss exclusion excludes losses that are a result of bad loans that a financial institution should have known better than to enter into. Third, the loan loss exclusion is also about allocating risk in a way that makes sense and does not create bad incentives. Part of that is a recognition that making loans is an inherent part of the bank's business. That is how the bank makes its profit, by lending money to borrowers and setting an interest rate or fees that reward it for the risk of lending. The bank is also able to control and decide how much risk it wants to undertake. And each bank can tailor or make their own judgment about what level of risk it is willing to tolerate. If a bank is uncomfortable with the amount of risk it is undertaking with a certain loan, the bank can, and maybe should, decline to write the loan. Or the bank can set appropriate fees or interest or other conditions to compensate it for undertaking a higher risk loan. But those business judgments that the bank hopes to ultimately profit from are risks that the bank voluntarily undertakes, and the bank has to bear the risk of loss from such judgments. Last, if the rule was different, it would create bad incentives. If every loan issued by the bank was insured against default, this would encourage sloppy banking practices, and there would be no incentive on the part of the insured to investigate the creditworthiness of borrowers or to prevent the risks within the bank's control. As the 11th Circuit says in Republic National Bank, if the bond covered every risk of default, we would be encouraging the bank to make loans not because the bank thought it was a secure loan or a good credit risk, but simply because the bank believed that the loan was insured. In effect, the bank would have no skin in the game and no incentive to avoid risky loans. The bank would instead be incentivized to engage in excessive risk taking that is not good for either the banking industry or the insurance industry. So, what are a few examples of this exclusion in action? Well, there are really a large number of cases applying the loan loss exclusion, but here are a couple representative samples. In Community Federal Savings, the bank made loans to a home builder based on representations that the homes it was building were fully complete and that all labor and material had already been paid. Those representations turned out not to be true, and the bank ended up taking a loss on the loans after paying out additional money to finish the buildings and satisfy mechanic liens claims. The court found that the loan loss exclusion specifically excluded losses from non-payment of loans, even where procured by fraud, and denied the insured's request for coverage. In Capital Bank of Chicago, the bank made a loan to its borrower that was secured by the accounts receivable due to the borrower from another company. But that other company had no record of the invoices and denied that it owed any money to the borrower. The court noted that the bank could have verified the pledged accounts receivable by making inquiries with the borrower's customer, but the bank did not. The court held that the loss was excluded by the loan loss exclusion. In Bank of Bozeman, the bank had purchased a participation in a loan that was secured by a pledge of stock certificates and corporate guarantees issued by Transcontinental Airlines. Even though the stock certificates themselves were forged, the court decided that the real cause of the loss was the worthlessness of the collateral the bank thought it was getting. Transcontinental Airlines was not a real airline and had no planes or assets or revenues. The court found that it was this inadequacy of the collateral that caused the bank's loss, and that this was a credit risk that was not covered by the bond. Finally, in Forked Bank, the court applied the loan loss exclusion in a case where the bank issued a loan secured by a life insurance policy issued to the borrower's owner. When the loan went into default and the bank tried to collect on the life insurance policy, it found out that the policy had a much lower cash value than the borrower promised. The bank also found out that it was last in line to collect because the policy had previously been assigned to several other banks. The court held that this was the true cause of the bank's loss, and that issuance of a loan backed by worthless or largely worthless collateral is a credit risk not covered under the bond. Obviously, there are many more applications of the exclusion that could be addressed, but what you see from these examples is the rationale of the loan loss exclusion coming through. All of these cases represent losses that occurred because of failures in the course of the bank's normal due diligence in underwriting and issuing a loan. A failure to make sure that the borrower's promises were true, that the collateral was collectible or had value, and that the bank had priority to the collateral over other creditors. Because those are normal credit risks that are an inherent part of the business of banking, the loan loss exclusion assigns the risk of loss in those circumstances to the bank and does not cover them under the bond. Well, that's our presentation for today, but I'm always happy to answer questions or talk about this topic more, so please do not hesitate to reach out to me at the phone number or email listed on the slides. Thanks, everyone.